All right, everybody. So today I'm going to give a little lesson on accumulation and distribution, actual, real accumulation distribution, where I show you examples, and you'll see exactly how it looks. You can even qualify it and quantify it. All right. So what you're taught is that accumulation or distribution generally is a box at the top of a trend, bottom of a trend, and that box fits a schematic: climax, secondary test, automatic rally, no, climax, automatic rally, secondary test, spring, more important sinus strength, LPS, all of that, right? This is what you're taught, but the reality is not that schematic like. Reality is a little bit different, and it's actually much simpler. So what happens is that when market is trending up and it hits distribution, it starts going a little bit sideways. So the thrust starts shortening and all this and that. But the clear evidence for distribution or accumulation at the bottom is not really shortening of the thrust, although that's one of the things that happens. Is not really climaxes, although that's one of the things that happens. It's basically just high volume that can't go up. It's just high volume that can't go up. That's it. All right? Because that really is the simplest way to do it. And I'll show you example after example after example. But that really is it. High volume that can't go up or high volume that can't go down. So when you have that high volume and it goes down, this distribution. When you got that high volume down, yeah, but it goes up instead, that's accumulation. It's really that straightforward. I know, we're taught about boxes and entire long processes, but the reality is it's just that volume, which is buying. And then what happens is they buy so much that prices have to lift up. Meaning they buy all of the float or supply or whatever, and prices have to go up because there's nothing there left to sell because this guy bought it all. And over here in the distribution, what happens is price goes down because whatever someone wanted to buy, the other guy sold, and then prices have to go down because he sold everything at this price, they bought everything at this price, and the other side sold everything at that price, so price has to go down. That really is it. All right, and I'll show examples of this. So this is, and I learned this because I was trying to figure out, how to clearly, very, very, very clearly identify accumulation and distribution. And the clearest way actually is in Wyckoff. All right, but not really the point and figure basis, right? Because the basis could be anything. And I want clear example of where the hell in the base is the accumulation, where is the distribution in the base. X's and O's are not going to help me. This is not going to help me. I have no clue. Where's the accumulation? Where's the distribution with X's and O's? Right? So the thing is, what Wyckoff did is he created something called the tape reading chart. Right? Now the tape reading chart replaced the X's and O's with actual volume amounts. So instead of X's and O's, you're going to see numbers. Instead of X's and O's, you see numbers. those numbers are actual trade volume. So this is a type of chart. You can call it tape reading chart, or you can call it accumulation distribution chart. But this is the only way, the clearest out of all the various indicators. You've heard of all the indicators that are supposedly, there's even an indicator called accumulation distribution. There's OBV, there's lots of different, things out there. But surprisingly, the one that makes the most sense to me, and I think anybody would, is this tape reading chart or the accumulation distribution chart. And it's really straightforward. Your market is going up, you get a lot of volume. What happens? Market goes down. There's your distribution. Done. So this is, and by a lot of volume, I mean a lot of effort. There's a lot of volume, a lot of effort, but it can't go up anymore. Instead, it goes down. That's it. All right. And now I'm going to show you actual examples that you'll see very clearly. So the one example I'll show is let's take a look at the ES where the last swing high was, and then pulled back on the daily chart. Why did it pull back? Where is the distribution? Because as you know, you have swing high, swing low, swing high, swing low, swing high, swing low, and very often you have the minor distributions here, 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 and minor accumulation here and here. At those pivot areas, there's minor accumulation and distribution until there's major accumulation or distribution, which leads to, the going the other way. So the question is, in the last up move, right? In the ES, where is the distribution or the minor distribution? Minor distribution is just, enough distribution to create a pullback. And major distribution would not only create the pullback, but would just change trend because it's going to break all the levels and all of that. All right, so we're gonna see where this distribution was on the ES. I'll show you completely clearly. All right, because the chart that identifies this type of work, that specializes in showing this, was created by Wyckoff 100 years ago. The only thing is he used it on an intraday basis for tape reading. So what I did, because when I went through his study, it hit me like a ton of bricks, that this could actually be used not only on a tick by tick basis, but on higher time frames. And so I modified it to be more clearer, with the, I'll just show you so you see it. But yeah, this idea is actually Wyckoff, but I just kind of, made it easier to read because I just highlighted, the big numbers. All right. So how I'm doing the reading. First of all, because I'm looking at more than one market, right? I need to normalize the volume. All normalization means is that I want to see it in terms of averages. All right. So what that means is instead of seeing 1,000 lot in the ES, not 1,000 lot, but 1,000 contracts, versus let's say 300 in crude, right? Instead of seeing it like that, I want to see it in terms of averages. So this, for example, let's say the average is let's say the average is, let's say 1,000 is the average, right? So in the ES, it would be 1. Because 1,000 is the average, so it's just 1. Here in crude, let's say 100 is the average. So this is 3 times the average. So this would be 3. So it's very straightforward, right? ES 1,000 is the average, would be 1. Crude, if 100 is the average, you would see 3. So this allows me to kind of jump from market to market and very easily determine if something has a lot of volume. If it's 2, it's a lot of volume. If it's 0.5, it's not even the average. So this allows me to very easily read any market quickly without going nuts, identifying, is this a lot of volume, is it a little volume, by reading the volume in terms of how much more or less is it than the average. Instead of seeing 1,000 lot or 1,000 contracts, I want to see in terms of averages. Is it 1 times the average? Is it 2 times the average? Is it 3 times the average? Or is it only like 25% of the average? 3 times the average is a lot. 50% of the average is half the average, so it's not a lot. So it's very simple, just seeing it in terms of average. So this is one modification I made, so I can very quickly read any market in terms of volume. This, I don't know why a lot of folks haven't thought of this or don't really do this, but as you can obviously see, if you're looking at more than one market, it'll make things so much easier because it's in terms of averages, right? This is called normalization. All right. Next thing is, I just want to highlight big volume. That's it. Just highlight it because sometimes there's too many numbers. I can't read everything, right? So just highlight it. So I use a white box to highlight what I consider large volume. And this can be volume at price. And if I have a volume column, the cyan, the blue, is high volume. So if the whole column has a lot of volume, it's going to be in blue. If it's a certain price, it's going to be in a white highlighted box. So that's really some basic adjustments that I made. And this allows me to very quickly see the accumulation and distribution and like real quick. All right, now coming back to the issue at hand. The idea here is, you see the ES right here, right? You see it right here? So there was distribution up here, minor distribution, that initiated the pullback. It seems like it's small, and you're right, it is small amount of distribution, but don't take it for granted, because on an intraday basis, that can be a significant sum of money, all right? And also the more important idea is to be able to detect it. Because if you can detect it, you can trade it. You'll be on the right side of the market. Why? Because after distribution, you have markdown, right? Which is profitable. This is what you short. And this is what you want. And after accumulation, you have markup, which is when you go long. To long and buy, so you can make money on the markup and make money on markdown. That's why accumulation distribution is so important. All right, so where is the distribution on the ES? It's right here. How do I know its distribution? How do I know its distribution? Now let's go through the example. So this column has 1.6 times the volume. So that's buying strength. It's good to go long the pullback. This column at the top has 1.9 times the volume, the average volume, whereas this one here only had 1.6. This has 1.9, yet it is smaller. It is smaller than this column. So this column has 1.9 times the average. It is smaller, and that's why it's distribution. Because you have a lot of effort and no reward. If this was reward, it would be a big column, but instead it's a little column. And then that right there is the distribution that caused this top. This top was caused by that. This distribution caused this top. Okay? This top is caused by this distribution. How much volume traded in that little area? It is 14 times 10,000. At that area was 140,000 contracts, and the buyers were not able to absorb it. The sellers kept selling, and that caused this pullback, which caused this down move, right? And you can see, even though I can't catch all of them, yeah, but the accumulation, where do you think it is on this pullback here? Look at this low right there. That is 90,000 contracts, and I can't catch them all, but that's 90,000 contracts. Does that mean it's accumulation? No. You know what means it's accumulation? The bar right after it, confirming that, because they bought everything, and that's why price went up, and that's why you have a green bar. It is 1.4 times the average volume on the column, and you have a nice 900,000. What is it? 90,000? 1 second. 9 times 10,000, so 90,000 contracts in that little area, and then price goes up. Why? It's accumulation. They bought everything. What happens when you buy everything? Prices go up. When you buy everything, prices go up. It's also a small column, which means a lot of effort. And then bang. And then after that, it goes to resistance, right? What happens at resistance? Absorption, right? What are they absorbing? This guy. After they absorb, boom, breakout. Now what's going to happen? There's some selling. Going to go right back into that area where the buyers were, and we'll see if they're still there. That is a clear example, folks, of distribution. 1.9 times the average, little column, only 3 boxes, volume right at the top, distribution, confirmation, reaccumulation, confirmation. Why? After distribution, price goes down. After accumulation, price goes up. Why? Because they bought everything. There's nothing left to buy, so price has to go up because there's nothing left to buy at that price low, so price has to go up. Like there's nothing left to sell, price has to come down. Okay? This is how the way the market works. It's just we need the tools and the knowledge to see it in a clear way. That's offered by Wyckoff, but unfortunately the stuff online that I've seen is 100%. I don't even know what they're doing, because the stuff online, I don't know. I just can't make sense of it. Anyway, forget that. But this is it. Selling, buying, absorbing. What happens after you absorb? Absorb is a type of accumulation, right? What happens? Price goes up. Why? Everything was bought at a price, so they have to go higher. That confirms the accumulation. All right. Now we'll take a clear example in crude oils. All right. So price here, look at how they're buying the pullback. So, all right. So we have a little breakout and market pulls back. As it pulls back, you see on this chart, the tape reading chart or the accumulation distribution chart, which I devised based on the works of Richard Wyckoff, that here, what is the volume? 2 times the volume. Is that a lot? Yes. What does that tell me? It means fucking pay attention. Why? Because accumulation and distribution will always be heavy volume. Always, because they're accumulating. They're buying wholesale, buy a lot, right? That smart money buys a lot. It's what you call a composite man's footprint is high volume. So these guys, this 2 times average volume 2 times average volume, right here. 2 times average volume catches my attention. I look at it. Okay, what is the next step? If this is accumulation, what needs to happen? Price has to go higher, because accumulation means you buy everything at the price. It's heavy volume because you buy everything at those prices because they're low, and that will lead to higher prices because everything is bought at the lower prices, so it has to trade higher. That's why what comes after accumulation? Markup, which is just saying higher prices, is markup, right? So here, bought everything. This doubled the 2 times the average volume. What happened? Bang, right up there, right? Done. By the way, this is the breakout volume right there, the 35. And today it offered, I think it offered a trade today, or maybe I'm mistaken and it was gold, but I don't remember. But here's the breakout volume right there, right? So there's accumulation volume, there's breakout volume or absorption volume, and then there's climactic distribution volume. High volume to start the move is accumulation. High volume to continue the move is breakout. High volume to end the move is the climactic distribution volume. All right, now let me show you another example. And I think this was the one, I remember this was it. Maybe this was it. Price pullback here. What's the volume amount? 2.7. 2.7 times the average. Is that a lot to you? Do you understand what 2.7 is? It's 270%. You understand what 1.5 is? 150%. Obviously, that's a lot. 2.7 is 270% the normal, the average. So this 2.7 is a hell of a lot of volume. Why is it a lot of volume? Because someone bought it here. How much? 45 times 1,000. They bought 45,000 contracts of gold in this area. I'm showing you clearly this isn't a fucking pattern. You know, this is actual number 45 and price. Then if it's accumulation, what needs to occur? If it's accumulation, that means they buy everything at the price. So what does price have to do? Has to go higher. What is that saying? Markup. Boom. Right there. Right? Anyway, now let's take a look at another example. Another example is here. This is more like it goes sideways. It's not that super duper clear, but it goes here. There's 20, and I think this is times 10,000 if I'm not mistaken, right? And then price goes up. That means they're buying this level. Here it's 21. What is it in terms of average? How much volume? 1.6, 160%. I like it. All right, 160% with a nice fat high volume print. What needs to occur to say this is accumulation? Does price need to go up or down? Obviously, gold needs to go up because they bought everything at the price. What happens? Boom. Up she goes. Pull back to test, and up they go. All right, now what I'm looking at is this euro. I don't know what the hell this is, but because it's a big bar, right? So the big bar goes all the way to test this area, and it finds 17, and this is 2.5 times the average. Now the thing with accumulation and distribution is, obviously it'll be at the top of the bottom, but I want it to be in small bars, right? Because it needs to be effort and no reward. So this, I'm not sure if it's a breakout volume or they're reaccumulating at that level. So it's a little bit confusing. I'm just going to step back. So I've given you 4 examples on 4 markets that clearly show accumulation and distribution, where again, distribution here, proven by price going down, reaccumulation here, proven by price going up. This is on the ES. Accumulation here on oil, on this double the average volume, proven by price going up. Accumulation here on gold, 45,000 contracts, proven by price going up. Heavy volume, or everybody buys the price, smart money buys, price goes up. How do I know? Big print, 2.7, 270%. Price goes up. Here, 20,000, I think it was, or 20 times 10,000, I don't know. I think it's 20 times 10,000. Shit, that's a lot of. And then over here, 21,000, price goes up, it's accumulation. Because accumulation will be high volume plus the price movement up or down. If the price movement up, that's accumulation was done. That volume is accumulation volume because price goes up, right? Because they bought everything at the high volume level. So here you go. This is the technique to identify accumulation and distribution. The best thing out there, I mean, if you can find something better, let me know. I don't know of anything better than what has been devised here. Surprisingly, it's 100 years old. I just modified it a little so it's clearer to read. But this chart was devised by Richard Wyckoff in the 1920s. 100 years ago. I've done a number of studies, and we'll show you this. It is available in Division 2 of his course. Go look it up online. There are at least 5 studies done by Richard Wyckoff and another 5 done by SMI. So at least 5 are directly written by Wyckoff that show this. The only difference is he does it on an intraday basis on a very, very minute level, tick by tick. I wanted to see it, if it would work, on higher time frame or higher box size, and it does. So I adapted it. And just, today's indicators and all that make it a lot easier to read. So now the question is, why the hell would someone want to see accumulation distribution? The reason is, if you have accumulation and price retests that area, you have a high probability trade. If you have distribution and price tests that area, you have a high probability short. Why? Because these are spots where smart money took positions. That's why. So if they took the position in crude oil right here, prices, if it tests that area, I'm looking for a long opportunity. Because the last time they accumulated, look what happened. Green bar, big bar, 1, 2, 3, 4, 5, 6. It went from 78. Last time they accumulated, it went from 78 to 83. That's why. If it retests that area, you have an opportunity for a big move. That's why you're so interested in accumulation and distribution retesting, because they set up good trade opportunities. I'll show you another example on the ES. This is the accumulation, or the absorption, whatever the hell it is right here. It's the buying, right? So when price goes back there, it's going to set up a potential trade opportunity. But obviously you have to see if the buyers are still there at that level. They were there before and push price up, comes back down to test. We want to see if they're still there and join in. And that's how you trade in the steps of the composite man. All right, take care, bye.